ladies and gentlemen. I warmly welcome you to today's webcast brought to you by the UBS Center for Economics and Society. In this world, nothing is certain except death and taxes, at least according to a famous quote by the American statesman Benjamin Franklin. But do all people and companies really pay taxes? Has it not always been a popular practice to avoid paying them as much as possible? And how can governments take action against tax evaders? Those are the questions we want to address today. My name is Florian Scheuer. I am the UBS Foundation Professor of Economics of Institutions and Chairman of the Department of Economics here at the University of Zurich. Raising taxes has always been a challenge for governments, but it is particularly difficult in low and middle income countries. Reasons for this range from a large informal sector, a small tax base, and a hard to tax formal sector, to limitations in fiscal, technical, and organizational capacity. However, tax evasion is also a problem in high-income countries. In a little less than 2 weeks, Switzerland will vote on the implementation of the OECD Minimum Tax Initiative. The current taxation of large, internationally active corporate groups is no longer appropriate, according to the OECD and the G20. With increasing globalization, they want to introduce special taxation rules for large multinationals. Around 140 countries have agreed that they should pay at least 15% tax on their profits. This is a clear sign that tax loopholes are to be closed. I'm very pleased to welcome my colleague Dina Pomeranz here with me in the studio to tackle precisely these questions. Dina is UBS Foundation Assistant Professor of Applied Economics here at the Department of Economics of the University of Zurich. Her research focuses on developing countries, in particular on public finance, taxation, and public procurement. Taking state capacity research to the field, she has worked closely with the governments in Chile, Ecuador, and Kenya to strengthen public finance capabilities and measure the impacts of various strategies on government agencies, citizens, and firms. Dina just earlier this year received a prestigious SNF Consolidator grant supporting her research on strengthening tax capacity in lower income countries while minimizing the burden on the poor. For this study, she is undertaking research in collaboration with the tax authorities in Tanzania and the Democratic Republic of the Congo. She has received many other grants and awards for her path-breaking work over the course of her career, so I'm really happy that she is here with us today and will share her expertise on these important issues. But before we start, I'd like to give you, our audience, some logistical information. Dina will be conducting live interactive polls throughout her presentation, and you'll also be able to ask questions, which we'll then have the opportunity to take up in roughly half an hour after Dina's presentation. To take part, please open a new tab in your internet browser or on your phone or on your computer. Go to menti.com and type in the code 14726007. You should also see this code on the screen. Even if you don't have any questions, you can still log in to view all the questions submitted by other participants, and you can also vote for the best ones by giving them a thumbs up or, of course, a thumbs down if you don't find a question interesting. All right, Dina, welcome again, and the floor is yours.
Thank you very much, Florian. I'm very excited to talk to you today about my research on combating tax evasion. I started studying this question because in conversations with policymakers, I realized that reducing tax evasion is a really important concern for many governments around the world, and increasingly so. So, for example, here we see headlines from Kenya, France, the United States, and so on, Manila, where everywhere governments are struggling with how to make taxes more fair and more effective. Why is this so important? Actually, no modern state can exist in the long run without effective taxation. To execute its various functions, from assuring security and rule of law to infrastructure, but also providing services such as education and health, governments need to have revenues, and to a large extent, that means taxes. So tax evasion therefore becomes a problem, but not only because it generates billions of dollars of losses in government revenue, but it also actually creates large distortions in the economy between activities that are taxed and other activities that effectively escape taxation through evasion. So that means that for a given size of government revenue, the burden on those who actually have to pay or have to comply, it'll be higher if other people don't pay their part. So strengthening the ability to effectively and fairly collect taxes is a central element of state capacity. Actually, many people don't know that also today's rich countries acquired their capacity to raise significant amounts of taxes only over the course of the last century. Here in this figure, we can see over time how taxes in Sweden, France, UK, and the US, as a share of global economic revenues, went up over particularly the 1920s to the 1960s, and 100 years ago, around 1920, the share of economic activities that was collected in tax revenue, share of GDP, was about as low in these rich countries as it is today in the poorest countries. And we can see here on this map that we can see this gradient that countries that have a higher GDP, that have a higher income, tend to have also a higher share of GDP that they collect in taxes. That means that low-income countries have very small public budgets because they have a smaller GDP, and that gets multiplied by a smaller tax rate, which ends up creating situations that a country like Liberia has a public government budget that is not much larger than that of Zurich. So that's why when I started studying economics in my doctoral studies and thinking about poverty, I started realizing more and more over time that taxes play a really important role. Many of you maybe when thinking about low-income countries or middle-income countries might think more of aid than taxes. So we have some poll questions here to make sure you don't fall asleep while I keep talking. So you can guess, and then we'll in a few minutes have the answers. How do you think tax revenues in developing countries compare to international aid? Do you think tax revenues are much lower than international development aid, public government assistance from the north? Do you think tax revenues are roughly equal, roughly similar to aid? Or do you think tax revenues are much higher than aid? So we'll come back to that in a couple of slides. So before we get to the answer of that, why is it actually that tax collection is much more difficult in low-income countries? A key challenge for any government to be able to raise taxes is information. In order to collect taxes, any government needs information about the taxable transactions in the economy. If I don't know somebody's income, I can't then go and enforce that they pay a share of that income in taxes. And so this is particularly challenging in lower income economies because the economy is less formalized. Both the firms are less formalized and the transactions are more often in cash and less easy to trace. And so that means that the government has much less information about these taxable transactions, which makes it much harder to collect the tax. And we can see this actually reflected in the tax structure. So here on this figure, you can see the difference between the type of taxes. In the red is for the non-OECD countries, so lower income countries, and in blue for the OECD countries. And Gordon and Lee have written this paper where they show that the forms of taxes that are more prevalent in lower income countries are the ones that are more likely to leave a paper trail, are likely to leave an information trace, also in lower income countries. And that ends up meaning that more of the taxes are collected from firms rather than individuals because there are fewer firms than people, so it's easier to focus on that for tax collection. And also the firms have more of a paper trail and organized books and things than a person. And so we can see in this figure here, there are much more taxes collected from imports and exports in the lower income countries. There are more taxes collected from goods and services, such as the value-added tax. And a little bit also more from the corporate income tax, especially over time that has been increasing. And on the other hand, less personal income tax as a share of tax collection. So now we can come back to what you guessed. in terms of the answer. So how do taxes compare to aid and other financial flows? So in terms of compared to aid, 43% of you think that taxes are much lower than aid, so that aid is much more important. That's the most common answer. And then 27 think that taxes are higher than aid and more important, and about a third of you think it's roughly similar. So what does it look like? Actually, it's very different in low-income countries than in middle-income countries. When we say developing countries, often we're putting very different countries together in one bucket. So in low-income countries that are very poor, that have income per person of $2, $3 per day, taxes and aid are about the same order of magnitude. On the other hand, in middle-income countries, taxes are much, much more important than aid. So as states grow economically, aid tends to fall and tax revenue grows. Or also, in other words, if countries want to grow out of aid, they need to acquire the capacity to raise taxes. Most countries in the world, by the way, are middle-income countries. So the share of low-income countries, it's about 10% of the world population, and the high income is about 15%. So most people are in middle-income countries. So the figure that you see there is the common. Also interesting that taxes are more important than foreign direct investment, more important than remittances, and so they play a really important role in these economies. So in today's presentation, I'll talk about two papers that I've written in this area. Now that you understand why I find taxes passionate, even though many people find them boring. So both papers are about tax evasion in firm networks, so between firms. And the government attempts to combat the tax evasion by collecting more information. One of those was very successful, the other less so. So the first one is on tax fraud through fake documents. Firms making illegal tax deductions by buying fake receipts from other firms that we'll talk about, the so-called ghost firms. The second one is international profit shifting across the border, where multinational firms reduce their tax bill artificially by shifting profits to affiliates in other countries that have lower taxes. So the first paper, called Ghosting the Tax Authority, Fake Firms and Tax Fraud in Ecuador, is joined with Paul Carrillo, who is from Ecuador, and Dave Donaldson and Monica Singal. So for a bit of background, we talked about how firm taxes are important in low middle-income countries, and the value-added tax is a big part of that. But what the value-added tax and the corporate income tax have in common is that firms pay taxes on revenues minus expenditure. So how you evade the tax is you either underreport income, the same as a person would, or you overreport expenditure. And when economies are very informal, it's very easy sometimes to just, underreport the revenue. You don't say you had any sales and be done. But as economies become more formalized, as we talked about, the information trail and so on, it becomes more difficult for firms to hide their incomes and to say they just didn't have any revenue. So this is one of my earlier papers that I showed that the paper trail on receipts that the customers get makes it harder to hide those sales. And what we also found in another paper is that firms then start to try to reduce their tax bill by increasing reported expenditures rather than underreporting revenue when it becomes harder to underreport the revenue. So ghost firms are a type of fake firm that is created exactly for that reason. It's fake firms that help other firms evade their taxes by selling fake receipts. So it's not a real firm, it doesn't have real activity. That's why in Ecuador they call them ghost firms, empresa fantasma. And client firms, who are a real firm, use those fake receipts to make deductions. They say they had expenditures, that means their profits would have been lower, and then lowers their tax bill. So how does this work? Here is a little picture. So the ghost firm is some entity that is legally registered as a firm, but doesn't really have economic activity except for selling receipts, where it says, I sold for $100,000 logs or whatever, services to this client firm. And so then the client firm can evade taxes by deducting those fake expenditures from their profits. And so to the tax authority, they report those receipts as expenditures. But on the other hand, the ghost firm doesn't report those receipts as income. And if the government tries to say, okay, wait a minute, there's all these receipts and you never filed your income, the government tries to find that ghost firm, there's actually nobody at that address. The person who supposedly owns that firm may be long deceased or might be subject to identity fraud. And so you can't really find the firm. You can then delete that tax ID, so it's no longer valid. But next day, nothing stops the people who organize this to just register and start a new ghost firm. So it's been really hard to fight this form of really organized tax crime, tax evasion. So in this study, we studied this global phenomenon that's very prevalent, especially in middle-income countries. And we worked with the tax authority using micro-level administrative tax data where we can see really the transactions between those real firms and the ghost firms. And we sort of answer two questions. First, we provide a window into the nature and patterns of this phenomenon. What does that look like? How frequent is it? Who does this? And then second, we evaluate an innovative enforcement policy that the Ecuadorian tax authority did, which was, again, instead of going after these ghosts, which are really elusive and they can spring up again very easily, they go after the ghost clients. And it turned out that it was highly effective, and probably other governments are going to learn from that approach and can use that also now. So in the first part where we describe a bit the phenomenon, I'll show you a bit what type of firm uses ghost firms more. So 3 options again on the menti.com if you want to participate. Do you think firms owned by owners with low incomes use more those fake receipts? Do you think it's more firms owned by owners with high incomes? Or third, the use of these ghost receipts is similarly prevalent, throughout the distribution of incomes? So again, I'll show you in a few slides the answer. So some other facts before we get to this question about the owners. So it turns out it's very prevalent. Even this is not the full sample of ghost firms that we know. These are just the ghost firms that the government has detected that they are fake firms. And looking at the transactions with these fake firms, we found that about 5.3% of all incorporated firms in Ecuador made at least one deduction from one of those 800 discovered ghost firms. We also could look at the type of transaction, and they're very clearly suspicious. So first of all, we see that the number and the value of ghost transactions increases a lot towards the end of the year, which is exactly when the firm goes and says, okay, our profit is a bit high, can we artificially lower it? Here, let's buy some fake receipts. On the left here on the figure, you see that for normal transactions, it doesn't change that much over the course of the year, while for these ghost transactions, in the last couple of months of the year, it goes up drastically. Second very suspicious pattern is that there's this very sharp bunching at the $5,000 mark, because Ecuador has a rule that if you are paying somebody more than $5,000, you have to pay them through the banking system or a credit card or some sort of electronic payment that leaves a paper trail and so then you actually have to make that payment. But remember, this $5,000 doesn't really get paid, it's a fake receipt. And so firms don't want to do that and then have to reimburse the ghost. And so we see a big bunching below that number that again indicates that these are not normal transactions. So what was your guess about, oh, sorry, I just showed you the results already. But it turns out actually, no, sorry, I got ahead of myself. This is firm size. So first, we have firm size. So what we see is the larger the firm, the more likely they are to have at least used one of those ghost receipts. So it's not a phenomenon that's just concentrated on small firms that are close to the informal sector. But when we look at the value of the transactions as a share of total expenditure, it also goes up and up and up. So small firms use it not that much. Firms in the middle and the upper half use it most, except for the very largest firms. And that with the very largest firms might be related to my second paper that we talk about in a couple of minutes, because maybe the very large firm have other ways to avoid taxes where they don't have to do this very obviously criminal activity of purchasing fraudulent receipts. And so here's with the question from the Mentimeter, where actually most of you, 80% got that right. Firms owned by high-income individuals use these type of fake receipts more. That was actually not something that was obvious to us when we started, because we first thought that this is maybe something that happens in the semi-formal sector, where the firms are newly formalized and they don't have enough of the right receipts, and they just purchase these receipts because they buy from the informal sector. But no, it's actually the very established firm, the relatively large firm with the richest individuals. And here we see also as a share of total income, it keeps going up with the income of the owner. And this also is in a way a nice place to do tax enforcement then, because enforcing this tax, instead of hurting the poor in Ecuador that are already very poor, it's really progressive. It really improves the tax fairness across the income distribution. And so this is what we find in the policy that they did to combat evasion, that mostly the rich people ended up paying much more back taxes from this. What is it that they did? So the Ecuadorian tax authority undertook this approach to go after the ghost clients, but first they had to go and find the ghosts. This is also why we have this data even. They looked at which firms in the tax filings showed up a lot in other people's tax filings as expenditures, but they themselves filed almost no sales. So there's a very large discrepancy. Maybe it will say in many other firms, you know, if I'm a ghost firm, then it would say they bought from Dina for 5,000, 3,000, 2,000. If you sum that all up, it's a lot of money, but then you look at my income and I say I only sold something for 200. And so somehow it doesn't add up. So they then said, okay, this might be a ghost firm. Let's try to find the firm. So they contact them via visit to the registered location. They called, they sent emails. And if they couldn't find them anywhere, they listed them on the internet. They said, here are firms that are suspected of being fake firms. If you're actually of the list and you are a real firm and we made a mistake, no problem, call us, we'll take you off the list. Almost nobody called. 2 or 3 they had to take off the list. And then the remainder they considered to be ghost firms. And then they looked at client firms, real firms, who took a lot of deductions, who said they had a lot of expenditures for paying those ghost firms. And they send them notifications like this that says the SRI, the tax authority, has identified transactions with firms that are regarded as inexistent for tax purpose or ghost firms that are engaged in pretend activities. You are required to either justify the veracity of these economic activities or file an amendment, and then you show the amounts. And firms responded very strongly. So those firms that adjusted their tax payments, they reported $230,000 in additional costs on average, almost doubling the tax payments that they had filed before the intervention. And so in sum, the targeting and prosecuting the ghost firms or their owners is very difficult. Governments have tried it, but the ghost firms don't really exist in brick and mortar, and the new ones can be created quickly. But policies that retroactively go after the clients can be highly effective, because the client firm is a real firm in brick and mortar, can't just disappear, and you know who the owner is. And so that seemed to be a very effective new policy. Okay, now we're going to a different type of tax avoidance or evasion, namely between multinational firms. So here we had sort of collusion or evasion between 2 firms in Ecuador, a real one and a fake one. In this case, it's now contacts between different affiliates that are all part of one multinational firm. So this is joined with Juan Carlos Suarez, Sebastián Bustos, José Villavelde, and Gabriel Zygmunt. This is the form of tax evasion that's most in the media. You might have heard, right? Tax avoidance by multinational firms, with firms shifting profits from subsidiary in high tax countries to subsidiary in low tax countries. For example, Google had a revenue of $75 billion in the Bahamas in 2019. that's not very likely because all of Google's customers happen to be living in Bermuda, or that all their employees work there. No, this has to do with tax advantages, right? And so the OECD has promoted policy reforms to try to combat profit shifting. And thus far, it's been quite difficult to study their impact, even though, as Florian alluded to in the introduction, there is growing skepticism whether this type of enforcement works. And that's why, for example, the new global minimum tax is on the table to see if we should change to another thing. But in this paper, we can really evaluate very detailed way the reform of the standard way that OECD has been doing, which is more and more reporting by firms about the transactions that they have with their affiliates around the world. And then firms have to explicitly justify their prices, so-called transfer prices for transfers to an affiliate abroad. And there's more monitoring by the tax authority to make sure that these transfer prices are done according to regulation. And we can measure with detailed tax data impacts on each channel of potential profit shifting and on tax payments. And then we combine this quantitative tax data with in-depth qualitative interview with the tax advisory industry. And we found the results that I found very surprising about the role of the tax advisory industry. First of all, very disappointingly for the Chilean government, we found no impact on profit shifting. So there are payments of Chilean multinationals to their foreign affiliates, and they follow the tax advantage. So when taxes in the country fall, the multinational will suddenly send more payments to that affiliate in that country. And we see no such association for payments to non-affiliates. So this really seems to be a tax-motivated payment. And disappointingly, the responsiveness to this foreign country tax rate does not go down after the reform. We would have thought if the reform reduces this practice that we would see less of that. And we can look at that separately for payments for royalties, for payments for services or interests, and for goods prices. Then, not very surprisingly, if we don't see any reduction in the shifting activity, we also see no significant effect on tax payments. This was very disappointing for the Chilean tax authority because when the reform was introduced, people were already debating in parliament how should the money be spent. You know, the left said it should all go into education, and the right said no, it shouldn't. And there is no money to fight about in the end. So did nothing happen? So we saw these results and we were kind of puzzled. Actually, we found that one thing did happen. Sorry, now I made, can I go back? Yes. Something did change. The reform created a boom in the tax advisory industry. So this is the last question you can guess for today, which is how much do you think the number of consultants that specialize in this transfer pricing, in these regulations around profit shifting, changed following the reform? So do you think it increased by 20%, it increased by half, 50%, it doubled, or it increased 12-fold? And again, I will tell you the answer in a couple of minutes. So this information about the number of consultants comes from in-depth interviews that I did with many people, both in the consulting firms and also in-house tax experts within the multinational company. I really like these interviews. It's so interesting. The favorite part for me about the research is always like talking to people and understanding what these phenomena mean in real life. So I asked them about their experiences during the time of the reform, and a very consistent story started to emerge that everyone I talked to seemed to tell very similar things. First of all, the reform created new demand for tax consultants because the new regulation required much more detailed reporting, which was complicated to comply with, and it was helpful to have specialized consulting services to help comply. We have many quotes in the paper, but here's one where somebody said a big majority of multinationals contracted the consultants for the new transfer pricing tax annex that had to be filed. Some did it in-house in the beginning, but then it was done poorly, and they received a complaint from the tax authority. And following this, they also started relying on consultants. So really the reform created this strong incentive for firms to use external consultants. Then the consultant, and those of you listening who have worked in consulting know, the consultant's incentive is always to upsell the client on the next service. And the next service for transfer pricing experts is tax planning. And advising on tax planning is easier once the big cost of organizing all the books and filling out those forms has been paid. And here's one consultant that said, in the first year, companies were only focused on compliance. But we told them every year about the tax planning services. You are losing a lot of money in this transaction. And sooner or later, they started to make changes to their transfer prices. Consulting firms see tax planning as a growth opportunity, so they focus on selling tax planning, says the consultant. Then the advisory consulting industry was actually able to respond very quickly to this demand by reallocating international experts. Now everyone is talking about labor shortages, right? And it's kind of not obvious that because demand goes up, supply can immediately follow. But this here was possible because this regulation is global and standardized. So a lot of people came from Spain, from Colombia, from Venezuela, from other Latin American countries to help with this regulation. So here somebody says the transfer pricing partners of the big four consulting firms were all foreigners. Still, many of the partners are today. The advantage for transfer pricing specialists is that the rules are international, so people can move around. A common tax planning advice that the consultants gave was to centralize cost centers in fewer locations. And this is kind of nice because we can now go back and forth between the qualitative interview and test the things people said in the quantitative data. So I asked the consultant here what was the type of things you would recommend when people do tax planning, and they say you optimize which location to have the services in. That is the best from a tax reduction perspective and maybe also from business considerations such as labor costs. So for example, you'll have one marketing department, one distribution center, one HR for the whole global corporation rather than little services in the different countries. And so we can test this in the quantitative data to see whether the Chilean firms make payments for services to fewer different countries after the reform. And here we see a clear response. So the number of countries to which multinationals make payments to affiliates after the reform goes down and down and down, which is very consistent with what the interviewees were saying. So now the final question is, so what should be the response? So the tax administrators seem to be really outmatched by the consulting firms, both in the number of transfer pricing specialists and in the salaries. Many more experts, much higher salary. So it's hard for the government to retain qualified experts. There's a revolving door of transfer pricing experts between government and consulting industry, and people keep leaving. So even the person that we worked with in the tax authority for this study now works at a consulting firm. And the guy who wrote the regulation for the Chilean transfer pricing reform also subsequently hired by a consulting firm. So is the solution to just hire more staff and pay them more? Maybe we should have more and more audits so that this evasion or avoidance becomes more difficult? Or will this just fuel the arms race? So I don't know the answer to this question. What I do know is that the consulting firms seem to see the additional enforcement as a good thing for even more consulting. One consultant said the big four, of course, benefit when the tax authority audits. The more audits, the better it is for the big four. So we have your votes on how much you think that the number of tax consulting experts increased after the reform. This is from before the reform to 2014. 14% think 20% increase, 12% think 50% increase, about a third of you think it doubled, and 40% got it right. It increased 12-fold. 12-fold. So here we have the big four companies, anonymized which is which, but they were 8 before the reform and 94 a couple of years after. So to sum, Chile implemented the OECD-based reform of tax enforcement on multinational firms The reform did not reduce the propensity to shift profits to low-tax countries and not significantly increase tax collection, but the reform created a large benefit for tax advisory services. And at least in this case, it seems like in the race between tax enforcement and tax planning, that tax planning won. So thank you very much. I think you sent in questions, and I'll hand it over to Florian.
Thanks so much, Dina, for your excellent presentation. Before we go to your questions, and I've received indeed a bunch of questions here already from the audience on my iPad here, I'd like to encourage you again to submit questions if you haven't already. So please go to menti.com and log in with the code 14726007. Thanks again, Dina. So before I go to the questions that were submitted here by the audience, one question that occurred to me was, you know, that you presented these two examples of collaboration with tax authorities in Chile and Ecuador. How do you do this actually in practice? How do you approach the authorities and convince them of your research questions and ultimately also convince them to share the data with you that you need to write these amazing papers?
Thank you very much. Yeah, so as I said before, like talking to people is like my favorite part of the research process. And when I started becoming a researcher, I wasn't actually sure whether I wanted to become an academic or a policy person. It just kind of happened throughout the course of my research that I realized one can do the type of research that is very close to policy. And so I work very closely with the people in the tax authority. In fact, I don't try to convince them of my research questions. We try to come up together with what are questions that are directly relevant to them and also of more broader academic interest. And so I spend a lot of time there getting to know the reforms they did, the questions they have, and so on. And so then it becomes like a win-win situation where I can work for them for free if we find a topic of mutual interest, and then they are happy to share the data because I analyze it for them. So this is really what kept me in academia, that I don't have to stay in the ivory tower.
Now, you gave us these two examples. One of them was a big success. The other one was actually a bit of a failure. Stepping outside of these sort of two very particular settings and interventions that these tax authorities did, are there any broader conclusions you would draw from this? So if I ask you, you know, what would be your personal opinion that tax authorities in developing countries should actually do to improve tax enforcement? You know, what would you recommend to them to do? We heard, you know, some things don't work, some other things work well. So, you know, is there something that you could recommend more broadly?
Okay, that's a big question. I think the first answer would be, as always with questions about lower and middle income countries, there is no easy solution. If there was an easy solution, governments would have already done it. So it's much more of a gradual process of keep improving step-by-step things. And what we learned is that deterrence really works. So you need information about the transaction in the economy and really then the ability to punish the firms if they don't pay the tax that the government detects. And so different things can help for that. Like in this case with the ghost firms, the government, you know, could prove to the firm that they had over-reported fake income for fake expenditures. So that's more information. And the government needs to have then also the credibility to punish the firms if they don't react to that. And there are different ways. And I think that's why I like to do this research, because it's not a priori obvious. I'm often surprised with the results. And so testing more things, I guess maybe I'm biased as a researcher, but I think is one way to go to see what we, for example, know doesn't work and doesn't seem to work anywhere is letters by the government encouraging people to please pay more taxes. Governments often, they like this idea because it would be nice, doesn't cost anything, but that doesn't work.
Now, the second reform you could also interpret as, you know, we're collecting more information, you know,
Yes.
we're forcing these firms
Exactly.
to also provide better evidence that their transfer prices actually make sense. And in this case, it didn't work. Is there something you could recommend there? You know, if you would make a suggestion how to tax these multinational companies in developing countries, that might actually work. It sounds like maybe putting more people into tax enforcement wouldn't even work because we have this revolving door issue and they will anyways always be outnumbered by the tax planning companies. Is there something that you could conclude from your research that might actually work here?
So I actually don't know the answer to that, right? I think it's great that maybe the policy space now experimenting with new forms like the minimum tax. It'll be interesting to see what happens with that. I find it hard to predict. I think what we can say, though, is exactly in line with what I said about information plus deterrence. This reform builds on the idea that more and more information is good, but it seems to be the case when the regulation is very complex and you can maneuver yourself out of it by buying more and more sophisticated consulting, then it's not enough to have information because it keeps being this arms race.
Yeah,
and
exactly.
so for simple taxes, where it's just, okay, a turnover tax being the easiest one, if you know the person had a sale, that's it. They have to pay X% of taxes. And so one implication might be that for limited capacity, you want to have simple taxes.
And that is also something that the OECD is pushing, because if we did move to a system where, for instance, your tax burden is only dependent on where you sell and how much you sell in different countries, so it doesn't matter where you book your profits, it's all about where you sell, that would be such an example of a simplification where all this tax planning would sort of break down.
Exactly, that's the idea. It'd be very interesting to see how it goes. When I talk to some of my friends who work in tax consulting, they're already telling me that the global minimum tax is the best thing that happened to their industry, because now they have more things to prepare, and maybe it's not that simple, so it sounds simple on paper. It will depend a lot on the detail of how it's implemented.
Great. Now, the most popular question here actually from the audience is people are wondering on a general basis, if you improve tax enforcement, so you put resources into actually raising more taxes, isn't that overproportionally going to fall on the poor who have the least means to, hire tax advisors and so forth? So isn't that inherently something regressive?
Yeah, so that is really a great question, because it's exactly what I've been thinking about a lot recently, and that's why this is especially a problem in very low income countries where it's very hard for the government to even know who has any money. And it's also especially problematic there because if you have people who are super poor and now you tax them, it can become life-threatening. Somebody cannot pay the doctor, somebody has to take their children out of school. So it's a real concern, and that's why you saw the papers I presented today, it's from upper middle income countries. The new projects that you mentioned for the new grant that I will be starting next fall are exactly focusing on that question. So how can we, or how can governments who work in a low information environment improve the targeting of the taxes and the timing of the taxes in a way that while raising the resources they need, it doesn't fall disproportionately on the poor? Because it's true that, in fact, in a lot of low-income countries, the government hasn't yet managed to make taxes really progressive like they are in rich countries. It's in part for political reasons, but a lot of it is really for that same information problem that if you don't know people's income, it's very hard to target those with higher incomes. And so we're going to be working on that. I'm actually going to Tanzania in July to start working with the government on that. And I think that's a very big question right now that's in the whole academic research and the policy space, to think about tax capacity in low-income countries. How can we make sure to raise tax capacity without being regressive?
There's a related question here which says the VAT is now the biggest source of tax revenues in most African countries. And it's sad that it was a decision by the IMF to actually foster this development. Could you comment on the role of the IMF in combating tax avoidance and evasion? Maybe more broadly, I think it's true that, developing countries rely more on these VAT-type taxes because it's just easier to enforce, which we also tend to think are more regressive than a progressive income tax, for instance. Is that something that these countries would be stuck with? And the person that asked this question seems to be worried that this is actually something that the IMF is encouraging. I'm not sure if you have some support for that, and whether the IMF maybe should come up with better recommendations for what these countries should do.
So I don't know the specifics of the role. I think that it's true that the IMF was involved in some of those decisions, but I think it's exactly for the reasons you say. It's not just in African countries. All low and middle income countries, the VAT is a big, well, the very low income countries, it starts with property taxes, a house, and tariffs at the border, because that's where you have information.
This
but
is
as soon as you move a little bit,
actually
medieval cities, exactly.
All, tariffs, basically.
Yes, but there's still, I know, like very close to where I live in Zurich, there's a port where people had to pay toll to go into the city of Zurich. There are also bridge taxes used to be very common. places where you can't hide the fact that you're doing some sales. But so from that, the next easiest tax is the value-added tax. It's actually very similar to a tariff in a way. And so countries build from there. But that's not just in Africa, but what we can also see is when countries then grow more, then they have more of a paper trail, more information on the corporate income tax and maybe the individual income tax, and they can grow out of that. So I don't think countries are necessarily stuck with that. But it's important, again, to be careful about how it affects distribution. Countries also do things like having relatively high exemption thresholds so that small firms that are mostly by the poor are not subject to the value-added tax. Or countries also
have different rates, right, on different goods. Where
different
we think
rates
some of them are more
on different goods, or goods that are completely exempt. So countries try, but it's a challenge.
Here's an interesting question that says Guyana, a new oil-producing country, has signed an oil contract that exempts Exxon from taxation. Is this sustainable? I guess the broader question here is if countries do these deals, you know, they want to attract foreign companies, and then they give them very attractive tax deals. Are they sort of shooting themselves in the foot by doing this, or is this actually a valuable strategy for some of these countries because it boosts economic growth?
I mean, this is a very small country, so it's probably a good strategy for them, but it's probably a bad strategy for the rest of the world, right? So this is this free riding with the profit shifting problem that we talked about, where some countries have become island countries, rich by they don't need that much tax revenue for their small economy. They can attract some jobs. But then there's exactly this profit shifting problem where even a low tax country like Chile still has profits being shifted out of the country because there's always a country that is even lower. And so I think this is part of this idea with the global minimum tax. I think for the countries themselves, it's probably often it's a good strategy for themselves. Switzerland too, it's a good strategy apparently for us.
Now, you focus a lot on firms and what we've talked about so far, and the corporate taxation. There's also tax evasion with individuals, right? And probably in low-income countries with the big informal sector and so forth, that's also a big problem. So would you think the broader lessons that you've drawn from the firm tax side would extend to what tax enforcement should look like for individuals, or is this fundamentally different?
No, it's exactly the same. It's actually the reason why taxes from individuals is lower, because there's much less information. Even less, if you see a store and they're selling bananas, you know that there's something being sold, but it's very hard to prove to somebody that they have a job. And so when economies are very informal, that's sort of much, you said the easiest is to tax a house, the second easiest is to tax a trade, then later you can start taxing income. It starts to work exactly when there's a paper trail, and in this case, and in many countries that's the case, the employer will inform the government that I as the employee had an income, and now it becomes hard for me to say I had no income. And that's how how countries expand their tax net to bring the individuals also into that net. And again, the individual can evade by underreporting their income. Currently, that's the main problem. But then, as you cannot evade anymore the income side, you can do a little bit of something on deductions. But there's not that much we have as expenditure. So, but we see this also globally. That countries went through this. We saw the figure earlier about how the rich countries increased their tax, and that they went through that process. Individuals started paying more tax when employers started informing the government about, say, wages.
Now, there's a lot of interest here from the audience on, obviously, the OECD minimum tax, because there will be the referendum here in Switzerland pretty soon, as we mentioned at the beginning. Switzerland is very different, obviously, from these low-income countries. Do you think this minimum tax initiative will have particular effects on low and middle-income countries that might differ from, for instance, the discussion we have here in Switzerland?
Yeah, so for low-income countries, it's probably not going to change much of anything, because if you think like the Democratic Republic of Congo, where I'm going to start to work, there's very few of these firms that are active in those countries.
And many of them also probably already have tax rates higher than 15%.
Yes, exactly. So my next question was going to say, if you have multinational firms, it's only going to affect you if you have a tax rate below 15%. There was some discussion, the global minimum tax should be 21%, and it may have been affecting more countries, but there are not that many. But now you mentioned some of these tax haven islands, who some of them are low middle income countries. Then for them it might have an effect that there's then maybe less profit shifting, if they have to have at least 15% and not completely exempt multinationals from taxes.
Now here's an interesting question which says sort of what you've showed in your studies are tax reforms that these countries had done, and then we evaluate them. And then when it turns out that it's not a success, that's a pretty expensive failure, because obviously there is a lot of effort going into the legislative process and so forth. So what this person here is asking is there a more efficient, better way to investigate tax reforms before they are actually being implemented at full scale? So we could do sort of systematic experimentation at small scale, what works, what doesn't work. And then based on these results, we then do big tax reforms actually and invest, sort of concentrate our energy in things that work in the first place.
That person who asked this question, thank you. You are my friend. That's exactly, obviously, as what we as researchers advocate, and what a lot of development economics beyond actually taxes is about. That we're saying testing things before scaling them up is much cheaper. Yes, it may have a cost to evaluate things, and you might have heard about all these randomized trials and studies, and we do randomized trials on tax policies. For example, we now know that sending letters motivating people to pay their taxes, you can save yourself that money. Some of the studies that I did are with these kinds of randomized pilots, and then if it doesn't work, you can focus your efforts on something else. Sometimes people are critical of those studies because they say, well, but if we know it's going to work, then why spend all this time evaluating and waste all this money for the cost of evaluating a thing? But as the person actually kindly said, it's actually very expensive to do stuff without evaluating it first, because it may not work and you may never notice.
Now here's a question that asks, why haven't we already fixed the problem of tax evasion in the first place? Is it a matter of political will that is missing? Maybe there's even a political will to keep tax enforcement imperfect, because there's this view that the government is corrupt anyway, so if it collects even more revenue, it would all be wasted, and this kind of starve the beast logic that we keep the government small and disciplined by constraining it in the amount of taxes it can raise. Now, you've done a lot of interviews with people in the second study, with people in tax enforcement. So this person is asking, are the people with which you talk to actually part of the problem, that they don't even have the political will? Maybe they're eyeing for the job opportunities in the private sector, as you talked about the revolving door. Or is it at a higher level that politicians and maybe even voters don't want to have perfect tax enforcement?
Okay, that is a very interesting question. It has different parts I'm trying to remember. So the first one was, is it capacity or is it a political will? Mm-hmm. And then the second is what people say in their interviews, and what's the role of the tax advisor. So I'm going to start with the first. I think it's both. So it's actually really hard to raise taxes in a low middle income country where there's not that much information. So with all the political will in the world, it's not an easy task. And so it's definitely not true that all of it is just corruption or lack of political will. Now, having said that, there is both, and that might be part of why it's hard to get the taxes in low-income countries to be progressive, because the local elite may be able to make sure that they don't get taxed more. And we just actually discussed offline before, the United States now have these debates about defunding the IRS, the American tax authority, with the idea that if you want low tax, you want low tax enforcement. But that's really a wrong way of thinking about it, because for a given size of the government, you want fairness, you want people to comply. First of all, it's really unfair if the other people don't, but it's also economically very inefficient, because people know from Italy, I hear that a lot, for example, when a lot of people evade, the people who pay have to pay a very large amount. Anyone who knows economics of taxation knows that leads to bigger distortions. And so from an efficiency point, from a fairness point, even if you like small government, you also want small evasion. And then the third question was about what's the role of these people in the tax authority and the tax advisors. And that's really a question I'm really thinking about based on these interviews. Like this is in particular, I think, the case for this taxation of multinational firms. Like the people who write these rules, including now the global minimum tax, the people who then work in the tax authority to enforce these rules, and the people who work in the multinational firm to help them deal with the rules, it's all the same people. And it's very, very specialized knowledge. That's exactly the people I talked to in the interviews, and they're actually very similar to us research economists. Spend years becoming good at this thing. They love talking about their work. There's a big pride in doing this right, and you become a very sought-after person when you know that, but then now nobody else understands this well enough to be able to say if this is going to work and what's going to be the impact. And so I worry a bit that even if people don't have nefarious intention, we all know what's in your interest somehow seems also be the right solution often, and then it's a bit problematic, the role that this advisory industry plays, and the more complex the regulation, the more powerful these few experts who actually understand it.
It's actually interesting because a lot of these tax advisors say they only do legal things. They're very insistent on this, that they're not doing illegal things. So that also supports their pride in the work. They're just helping firms to actually comply with the actual tax code. But then there's sort of an equilibrium, because if you think about many countries have this rule that, for instance, any transaction that is only done for tax purposes and doesn't have any economic substance is illegal. And I think in general, a lot of these transactions are nonetheless done by these tax planning firms. You know, you set up shell companies in some tax havens. And it's because the tax authorities never go after these things, even though it's sort of on paper it would be illegal, but there hasn't been the resources to actually enforce this. So it's a kind of, I think the revolving door that you mentioned is important, because there's a kind of equilibrium of what is acceptable, what is not acceptable in this gray zone of what is actually legal versus not.
And I think that's the whole point, like with the regulation being complex, like what becomes legal, you have to be able to prove to the firm that there's no economic reason to do that other than taxes, and so the role of the expert is to help you find the legal reason. So substance. It may not be illegal, but for example, I talked to one of the people in the multinational firm, and to your point about pride, like the person was saying, we were so naive before, we were so inefficient, it was like totally not sustainable. We are a sustainable company, we are good for the environment, we're sustainable socially, and now we're sustainable with taxes. And then he was saying, for example, you know, I thought naively that when I have a patent and a foreign affiliate uses it, they have to pay me for the use of the brand. But then the tax expert explained to me, no, but if that company abroad is making losses, then clearly, like for them, they're bringing that brand into a new market where it's not yet established. So actually, you pay them so that they promote your brand in a new market. And that's now justified completely as a market logic, but you wouldn't do it if the other firms didn't make losses. And so why these specialists are the very smart people is that they find actual economic reasons that happen to align with tax advantage.
Fantastic. You can see Dina and I could continue for hours about these topics.
We should.
I have to apologize. There's many more questions that we actually, for time reasons, can't take on, but obviously this is a very, as always with taxes, it's a very energizing topic. Thanks again, Dina, for this very exciting talk and the discussion. I've definitely learned a lot during the last hour. I'd also like to thank you, our audience, for participating today and for sending us questions. We hope that we've stimulated more broadly your interest in our activities here at the UBS Center. With this webcast, we say goodbye for the summer break. We are very excited to announce our events for the next upcoming semester. We have an excellent program on the topic Democracies Under Threat. So on October 24, Wolfgang Schäuble will give a public lecture at the University of Zurich. And then on November 7, Steven Pinker will be our guest with another public lecture, also here at the University of Zurich. And then on November 13, we will again hold our annual Forum for Economic Dialogue. Among others, Helen Landemore, Jason Brennan, and Daniel Zieblatt will give presentations and participate in panel discussions. So if you'd like to receive updates on our events and activities, please subscribe to our newsletter. We look forward to welcoming you back next semester. In the meantime, I invite you to follow and continue the discussion on social media, Twitter, LinkedIn, and YouTube. You can find all this information on the UBS Center's webpage as well, ubscenter.uzh.ch. Thank you and goodbye.